Good day. Our group was tasked to report on decision analysis topic. Specifically, we are going to discuss the Fly Ash Brick project, a feasibility study using CVP analysis. Before we begin, we would like to acknowledge the efforts and valuable contributions of all our group members listed on this slide. I am Nympha Velasco, and reporting with me is Ms. Charmaine Galgo. On our team are Ms. Cheryl Tudor, Dr. Maria Lydia Bautista, Dr. Josephine Pumitan, Ms. Angelique Ruby Dagot, Ms. Catherine Lopos, Mr. Benain Cacleong, and Ms. Angel Camille Castor. They have given their time, ideas, insights, and talent to finishing this report. Our topic will cover 5 points: the background, statement of the problem, alternative courses of action, recommendations, and key takeaways. We'll start with the background of the case. The Fly Ash Brick project is Rajiv Sharma's dream. He did a market research and proposed a business plan that has a huge potential for profit. Having worked in the construction industry for many years, he was very sure of his dream project. He convinced his friend Alok Gupta to agree to his business idea. He was interested to invest but has doubts and requested to review his business plan. The business central idea is to use fly ash as the main component of bricks. Fly ash is a residue obtained after the combustion of coal. In short, it is a solid industrial waste. Coal would continue to be used as prime fuel for many more years in India, since 90% of thermal plants uses coal. Fly ash has posed disposal problems as it required to be buried in landfills requiring about 1,000 square kilometer area. Fly ash can be used in the manufacture of ceramic tiles, bricks, building materials, cement, and others. Thus, the government promotes the use of fly ash bricks for 2 reasons. 1, when used as a construction material, it eliminates the waste and reduces the need for huge landfills. 2, when used as a clay brick substitute, it helps preserve the fertility of the soil, thus conserving the environment and natural resources. At present, thermal plants produce 100 million tons of fly ash per year. Only 40 billion tons of fly ash are being used, requiring 50,000 personnel. If all of the 100 million tons of fly ash will be used, it will create employment for 300,000 personnel and a business volume of 40 billion rupees. This diagram shows the manufacturing process. It starts by mixing 4 components together, with fly ash being the main component. The process is quite similar for clay bricks. Inspection is a very important part, as the National Thermal Power Corporation of India wanted to guarantee the quality of manufactured bricks and that all plants follow the guidelines of the quality standard, Sharma's plant included. Thus, with that said, the use of fly ash is a priority since it assures the regular supply of bricks without environmental damage. The annual demand for clay bricks for construction purposes is around 180 billion tons. To create 180 billion tons of clay bricks require 340 billion tons of clay, which would lead to serious ecological problems since topsoil is required in the process. If clay bricks will be replaced by fly ash bricks, that already assures a demand of 180 billion tons of fly ash bricks. The quality and durability of fly ash bricks were very suitable in many construction projects. With the increase of construction activities is the rise for the demand of fly ash bricks. The housing sector alone was predicted to experience a shortage of 20 million to 70 million housing units. That will require more bricks as a raw material in construction. On the basis of preliminary analysis, Sharma decided to set up a plant that would have the capacity to manufacture 4 million bricks. He presented the calculations for discussion. The initial investment in fixed assets will be around 8 million rupees. The major expenses would be in transport vehicles, machinery, and building modification. Water supply is a minor expense. Routine expenses related to rent, administrative costs, and other miscellaneous expenses would be 95,000 rupees. Salaries will be around 160,000 rupees. So 160,000 rupees and 95,000 routine expenses gives us a total of 255,000 rupees of fixed costs. Materials, electricity, and labor for making the bricks would be 900,000 rupees per month. These would fall under variable costs as they are related to the volume of production. Sharma is looking into a plant that has the capacity to produce 4 million bricks per year. However, full production capacity is not possible since the actual production depends on market demand. So if there are no buyers, they won't produce bricks since that would only incur variable expenses. Since machines also wear and tear with use, outputs will decline when one equipment breaks down or the plant shuts down for some reason. So therefore, the expected sales volume is at 2.4 million bricks per year. The average selling price is 7,000 rupees per 1,000 bricks or 7 rupees per brick. The proposed business plan would need an initial investment of 10 million rupees. 6 million would come from the partners' local resources, and 4 million will be loaned at the bank at 12% per annum against their equipment. As the brains of this project, Sharma will work full-time with a salary of 50,000 rupees per month. The project is expected to last only 5 years, after which the plant and equipment salvage value is negligible and therefore can't be used for its original purpose. Their working capital, or assets minus liabilities, would still be recovered in full. Sharma and Gupta decided to consult before investing. So our problem is to determine through CVP, or cost volume profit analysis, whether or not Sharma's fly ash brick business plan is feasible. What is CVP analysis? It determines how changes in costs, both variable and fixed, and sales volume affect a company's profit. There are 5 main components under CVP analysis. 1. Cost margin ratio and variable expense ratio. 2nd, break-even point. 3rd, margin of safety. 4th, changes in net income. And 5th, degree of operating leverage. We are going to calculate and explain the significance of each values later on. To start with, we need to show the contribution margin income statement. In this table, you will see 2 columns. One shows values per month, and the other one shows values per unit. Since the expected sales value is 2.4 million bricks originally, we divide it by 12 months to get 200,000 units. And the price per unit is 7 rupees, so that gives us a total sales of 1.4 million rupees per month. We are going to deduct the variable costs or the cost of production. So for 200,000 units, the variable cost is 900,000 rupees. Or per unit, that would be 4.5 rupees, which gives us the contribution margin of 500,000 rupees or 2.5 rupees per unit. The contribution margin ratio is the product's price minus all the associated variable costs, as you can see here. Or it is the incremental profit earned for each unit sold. So incremental profit earned for each unit sold. Or this is the amount of sales available to cover our fixed expenses. So now we have 500,000 rupees, and from which we are going to get our payment for our fixed expenses. If there is a remaining balance, it provides the profit for the period. So less our fixed costs, remember these are the salaries and administrative costs per month, which is equal to 255,000 rupees. Then this gives us a net income of 245,000 rupees per month. So the cost margin ratio is a good way to determine if a company can afford to put a product on sale for a certain price and still hits its target. First component under CVP analysis is our cost margin ratio and variable expense ratio. Cost margin ratio is calculated by dividing the contribution margin over the total sales. So remember that our contribution margin was the sales minus our variable expenses. So that's 500,000 divided by 1.4 million rupees. That gives us 35.71%. So remember, if the margin isn't large enough to cover the fixed expenses, then there will be a real loss for that period. So since our margin is large enough to cover our fixed expenses, then that means that it's still feasible. We've also mentioned that it is a good way to determine if a company can afford to put a product on sale for a certain price and still hits the target profit goal. The second value here is our variable expense ratio, wherein we divide the total variable cost by the sales. So to produce 200,000 units of bricks, we need 900,000 rupees divided by the sales, which is 1.4 million rupees. That gives us 64.29% as a variable expense ratio. So this will help us determine how profitable a company is. It is an indicator of whether a company can achieve a balance of revenue streams when the revenue grows faster than the expenses. So according to this data, we have a high variable expense ratio, 64.29%. So most likely, there are not a lot of fixed costs in the production process. So this means that the business has to generate enough revenue so that it can cover the fixed costs in the production process. The business will stay operational without making any significant profit in sales. With high ratio, we can make profits on relatively low sales because there are only modest fixed costs. So low variable expense ratio means our break-even point is high. But since we have a high variable expense ratio, we don't need to have a very high sales, or we don't need to have a very high break-even point. On this account, or under this component, we'd say that Sharma's business plan is very feasible. Next component of CVP analysis is our break-even point. So the break-even point refers to the number of products, or in our case, the number of bricks that our company must sell to cover all production costs, both variable and fixed. The break-even point is calculated by identifying the total fixed cost divided by the cost margin per unit. So if we go back to our income statement, the total fixed costs, that would be administrative fees, rent, salaries, is 255,000 rupees. And the cost margin, which is the price per unit minus the variable cost per unit, is 2.5. So that would mean we need 102,000 units. What does this number mean? If they sell 102,000 units, the profit will be 0 and the company will break even, which means the break even only covers the production cost. No profit, but the company also does not lose money. And since our target sale is 200,000 units per month, we could still say that Sharma's business plan is feasible. The third component is the changes in net income, or this is also referred to as what-if analysis. So this is to estimate how net income will change with the changes in the sales behavior. So for example, if we want to earn a profit of at least 200,000 rupees, how many units should we sell? So this is determined by how many units are we going to sell if we want a profit of 200,000 rupees per month. So we need to add fixed costs plus our target profit divided by our cost margin per unit. So based from our table, that's 255,000 rupees. That's our fixed costs, salaries and rent. Our target profit is 200,000. So this could be higher. It depends on what or how much profit you want to earn per month, divided by our cost margin per unit, 2.5. So that means we should be able to sell 182,000 units if we want a profit of 200,000 rupees per month. So if we want a higher profit, that means we also need to increase the number of units that we need to sell. The fourth component is what we call the margin of safety, or this is our wiggle room, which means it tells us how much sales can drop and yet break even, which means we're not going to profit even if our sales drop, but then our company will not lose money. So the margin of safety is calculated by identifying our actual sales minus our break-even sales. So again, if we have 200,000 units times 7 rupees per unit, that gives us actual sales of 1.4 million rupees minus our break-even sales. So remember, in order to cover the production costs, we need to sell about 102,000 units multiplied by 7 rupees, the price per unit. So that would give us 686,000 rupees as our margin of safety. Or you could also calculate it as a percentage. So you have our break-even sales, 714,000 rupees, divided by our actual sales, 1.4 million rupees, would be equal to 51%. Now, what does 686,000 rupees and 51% represent? That means that sales can drop by 686,000 rupees. So instead of our target 1.4 million rupees sale, it can drop to 686,000 rupees. And or the sales can drop by 51%, the company will still not lose money. That is our margin of safety. And the fifth component, last component of CVP analysis is the DOL, or the degree of operating leverage. This is a very important number because it tells us how our net income changes in relation to sales number. To find our DOL, we need to identify again the cost margin divided by the net income. So our cost margin is our sales minus variable expenses, so that's 500,000 rupees. Cost margin minus our fixed expenses is 245,000 rupees. So 500,000 divided by 245,000 gives us 2.04, or we can just round it off to whole number 2. What does this number mean? 2 means that 1% changes in sale will cause 2% change in net income. Now, some people say that the higher the value, it's better. But that is only if we have an increase in sales. Now, remember that for every 1% change in sales, this value also indicates our change in net income. So if there is an increase in sale, the higher the value, the better. But if there is a decrease in sale, that also means that 1% decrease in sale means 2% decrease in our net income. So I think the value 2 is a very good number, since even if our sale decreases, it's not going to affect our net income very much. Now let's summarize our findings. Based on our CVP analysis, all the numbers indicate that the business plan is feasible. However, it is not very profitable. Our profit is not very high. Remember that in order to put up this business, we need an initial 10 million rupees for investment. 6 million of that will come from the partners Sharma and Gupta. However, they are going to get a loan of 4 million at 12% annual rate, which means every year the 4 million loan is going to get 480,000 rupees interest, or that would be equivalent to 2.4 million rupees in 5 years, which is the project life. So, which means the original 6 million investment from the partners and our 4 million plus 2.4 million in interest brings our total investment with loan interest to 12.4 million rupees. At current projected sales per month, we have shown you the calculations. The net income is only 245,000 rupees per month. Or, if you're going to multiply the said income, that would be equivalent to 14.7 million rupees in 5 years. Or, the total net income in 5 years would only be equivalent to 2.3 million rupees, which means the net income is only 460,000 rupees per year. So imagine that the net income per year is actually lower than the interest rate per year. Now, this is going to be split between Sharma and Gupta. If you're going to do further calculations, each investor will only enjoy 19,166.67 rupees net income per month. So, which means it is feasible as the CVP values indicate. However, it is not very profitable. So this ends my part. Ms. Charmaine Galgo is going to talk about the alternative courses of actions.